Hello, everyone. Welcome. Good evening. So excited to, well, we can't see you, but so excited to welcome all of you. I will pin Nick and I here. And the first thing you probably notice is that Nick and I are apart. So that's pretty fun. So I am joining you from our home in Rochester, Minnesota at our office where we usually have our Zoom calls. And Nick is joining us from Tacoma, Washington, our second headquarters, where we are under contract for a new opportunity that will go into Fund 2. So he flew out to Seattle to look at our other projects there, Garden Court West, which is a joint venture, Tanara Villa, which is in Fund 2, and then take a look at our new acquisition. So all very exciting stuff to share with you today. I would love it if you all could say hello in the chat so we know that that's working. Maybe pop a question into Q&A so that we know that that's working. Jennifer said she's driving, so can't be on video. Stay safe. We try to do everything we can verbally as much as possible and want you to be very safe. So very excited about our time together tonight. Nick, anything that you want to add as we get started here?
I'm just excited to be here. It's been a whirlwind trip here. We just got under contract on Friday, and we really want to close by the end of the year. So we had a short due diligence period. So I hopped on a plane out on Sunday. Kind of spent the weekend with the family, and then I think I arrived at like 11 p.m. Went straight to the asset that we're looking at, and just kind of hung out for about 90 minutes. Just walked, kind of like a 12 block radius around. Just I love to see an asset at every time of day, got a few hours of sleep, and then back up and at it today. So it's been a long couple of days, but and then this just happened to be the time for our performance report. So I'm excited to be here. I'm on my fifth cup of coffee or something like that, but I'm excited.
Awesome. I see that chat is disabled. Rachel is enabling chat right now. We do have Q&A working, so we can, if you have something to type in, we can see it there, and Rachel will be monitoring all of those things this evening. I will go ahead and share our screen so we can do our slides. Can I get a confirmation from someone that the screen share is working? You'd have to do it in Q&A if someone doesn't mind. It looks like it's working on my phone here.
Oh, looks like chat's working.
Awesome. Okay. Well, let's get started. So for those of you that maybe don't know us, I'm Elaine Stoggenberg, owner of Black Swan Real Estate. That's my husband, Nick Stoggenberg, owner of Black Swan Real Estate. And we are so excited to do our quarterly update. We do not only a written quarterly update for our funds, but also we do a live presentation to share all of the things that are going on, share pictures, financials, all of those things, and then also have an opportunity for Q&A. So one of our company values is radicalized transparency, and we do that through these quarterly updates. And we just think it's a lot of fun. There's so many moving parts happening at all times, so many renovations. I think as of today, we have like 57 active renovations happening somewhere in the company. And there's just a lot to share. And so we love getting together and doing these with our quarterly updates. So let's get started. A little bit about us. We are actually, let's skip to this slide. This is a couple of pretty exciting milestones for the company. So thank you to all of our investors that have made this possible. So Black Swan Real Estate is now at over 1,000 doors in both our Rochester and our Tacoma holdings, and we are at 1/3 of $1 billion in assets under management. We set a target about a year ago to hit $1 billion in assets under management in less than 5 years, and we're well on that path. And just so grateful for our investors that we can support in their financial freedom journey along with us, and just excited about what we've been able to accomplish together. So thank you. Nick, anything that you wanted to add there?
We want to change the world, and Elon Musk isn't going to change the world by selling everyone a car. All he has to do is sell enough cars to prove that everything can be different, or send enough rockets into outer space to prove that everything can be different. And so Elaine and I figure if we just get $1 billion in assets under management in a totally different way than we've ever heard of before, in a way that we think makes the world a better place, well, maybe the whole world might change in some small way.
Very exciting. Let's jump in to Black Swan Real Estate Fund 1. this is usually where Nick and I are together, and it's
Yeah.
obvious to him that I would like him to
Sure.
speak, but we're
Sure.
we're doing this apart.
So
Go for
we're
it.
unbelievably excited about Fund One. It was a $10 million fund. We ended up raising about $16 million in one day. We were only able to keep 11 million of that because we had sized it at 10 million. So that's what our attorney said there. And this was the scary moment when we kind of launched this first experiment. We used this exact same structure in joint venture partnerships for single assets or small groups of assets countless times. But this was the first time we did the big fund thing. So really exciting, and just the support for this has been absolutely overwhelming. I don't know, this Fund One's always going to be our baby or something like that. I don't know, or it's always going to be our favorite. So it was Reg D 506C 100K minimum, targeting an indefinite hold period with 100% of the profit going to our partners until all investor capital was returned, and then a 50-50 split after that, with no fees whatsoever. So really just unheard of in the industry. I'm still not aware of any other funds out there with no fees. There's a question, what's a Reg D 506C? So that's like a chapter of the SEC code. So that means that you must be an accredited investor in order to participate. That's the best practice way to implement a fund like this, so that we can advertise it publicly and kind of be on the up and up there with the SEC. So unbelievably excited about Fund One, and unbelievably excited about its outcomes so far.
So Fund One's main holdings are the Nicholas and Oliver apartments, and then also a portfolio of single family homes. So we closed on the Nicholas and Oliver apartments on December 28th of 2021. They are essentially a conjoined building. So anytime you see Nicholas, that's kind of our shorthand for both Nicholas and Oliver apartments. Nicholas is 83 units, Oliver is 12 units combined. It's a 95 unit apartment building. Nicholas is exceeding our pro formas. We are very excited about the rent growth that we've been able to see at Nicholas, about very low vacancy. We did renovate 12 of the units, the 12 units in Oliver. We took out all of the carpet, put an LVP, did a gray paint scheme throughout just to make those units a little more bright. And we're finding a rent premium from that. Our Q3 rents for Nicholas were a little under 150,000 per month at 147,000 per month. So very excited about our income there. It's a very lean asset in terms of operational expenses, just exceeding all of our expectations. Anything, Nick, that you want to share about Nicholas?
We're blown away our pro formas there. I think in our original pro forma, the in-place rental rate, for example, for a studio was $1,030 per month. We had penciled in maybe 1,100, and I think we've proven at least 1,300. I think maybe now 1,350 for a studio unit there. Just blowing away our pro formas. We were thinking maybe we would hit $1 million in pro forma NOI. And on a go forward basis, now that things are pretty stabilized and we've renovated so many units. I mean, I think we've renovated probably 50 of the 95 units so far in total, which is just a staggering pace to turn over, renovate units that quickly. So looking at our historical income kind of handicaps us because we've turned over so many units there. I think our go forward income, our go forward NOI is going to be well over $1 million on that particular asset. So just really could not be more pleased with our outcomes for Nicholas. I think on our last call, we talked about implementing our new internet system that's going to add 7 figures of value to it. Just got off the phone talking to our engineer. We're still working on a city approval process to add more parking units to Nicholas. I don't know, I could spend a long time talking about Nicholas, but we do have a lot of assets to cover this evening, so I'll let it go.
The other holdings in Black Swan Real Estate Fund One is a portfolio of 40 single family homes. So we acquired all of those homes at the beginning of 2022. All of them have had very exhaustive renovations. That's really part of our BRRRR business plan, is to acquire homes that need a lot of physical renovations. All of those renovations are now complete. So a very fast pace to make that happen. Obviously very capital intensive to acquire those properties. They were vacant during the renovations to pay for the renovations. And now all of them are leased. So we're very excited about the pace that we were able to make all of those projects happen. Our annualized rents for our single family home portfolio is a little under 700,000 at 697,000 per year. And that's on a go forward basis, because if we look back, where we were acquiring the properties and then they were vacant during renovations. Our year to date income for Fund One is about 1.27 million. For our single family home portfolio, it's also important to note this is a big celebration for Fund One. We completed our first cash out refi for a portion of those single family homes. So that's a big part of our plan, is to acquire properties, to do renovations, and then to do a cash out refi. And that capital churn is what is allowing us to acquire a portion of residences at Discovery Square in Fund One. So the total asset size for Fund One for a $10 million fund will be about $50 million after we acquire the portion of residences of Discovery Square. And then we have additional capital to continue to place single family homes in Fund One. And the reason this is so important is that when we're in that infinite rate of return period, it intuitively makes sense that you want to have an infinite rate of return from the largest bucket of real estate possible. So we're always thinking about how can we maximize the size of the assets that are owned by any given fund, maximizing the use of those dollars, so that for that 20 to 25 year period, that's an infinite rate of return, we're collecting an infinite rate of return from the largest amount of real estate. So very excited about Fund One. I would say that's exceeds the industry because we have such great lending relationships. We were able to acquire Nicholas with such favorable financing. We were able to do this first cash out refi of a portion of the single family home portfolio so quickly, and then use that capital to acquire a stake in RDS. And so for all of those reasons, we're at like a 1 to 5 ratio of capital to assets, which is large. Most funds are leveraged at like 60 or 70% or maybe even less. And this is a really important part to make those 20 to 25 years of an infinite rate of return as lucrative as possible.
I mean, if you take nothing away from our whole presentation today, what Elaine just said, that's the most important thing for you to understand about Fund One, about all of our funds, about our business model. So, it's a common, tactic in the industry to like lower your leverage, to get like a lower LTV loan, to increase your cash on cash rate of return, especially if you have to, pay out a pref that may not necessarily be like a realistic payment in market conditions. So if you go get an asset at like 90% LTV or 80% LTV, you're going to have way lower cash on cash rate of return than if you get an asset at like 50% LTV. But when you get those higher LTV assets, your total rate of return goes way up. So in a typical fund of the size of Fund One, you might have 35 million in assets tops. We already have 50 million in Fund One, and we're still going. Mm-hmm. And everybody is along for this ride forever. So like in the short term, our cash on cash rate of return is lower, and that's a deliberate trade-off that we make, because 10 and 20 years from now, we're going to be excited that we have, 50, 60, 70 million dollars of assets in a fund where we only started with $11 million in cash. That's unheard of in the industry. And these are very conscious decisions that we're making. So I hope that concept makes sense to everyone on the call. If it doesn't, feel free to put questions in the chat. We can maybe circle back around to that at the end, but that's like a mic drop moment right there, that we're going to hit $50 million in assets in Fund One this year. Most funds in the industry, they might tap out at 30 or maybe 35 million in a fund this size. And we're still going because we've hit our first cash out refi in Fund One, and we've got another one coming up here in probably a month or maybe less. Like we're still trucking along here, acquiring assets in Fund One.
Absolutely. And if you do have any questions, please put those in chat. That's a big part of why we do these quarterly updates live, is to be able to have an opportunity to ask questions. Adam asked about, do you worry about leverage with the increasing interest rate environment? So that's something we get that question every single day. We obviously have to think about it a great deal. We have to think about it with our business plan. So it's important to note that an increasing interest rate environment affects everyone. So even if our plan was to sell these assets, that would impact the potential buyers for these assets, which would impact us as the sellers. So an increasing interest rate impacts everyone. We saw this coming for all of our assets. If you look back at our webinars and our community hours, we were beating the drum of get your cash out refis before interest rates go up. And so we locked in our financing for the single family home portfolio refi in early summer. We went to our banking partners and we said, here are some of the homes that we have acquired. We hadn't yet acquired all of them, but we plan to acquire very similar homes. Here's our entire portfolio. You can look at all of our rent rolls, all of our renovations. We can drive you all around town. You can look at what our business plan is and see it with your own eyes. Let's lock in the debt package that we will have when we do our refis, but we can't do our refis until after our renovations are complete so that you can see the after repair value. So the debt for our single family home portfolio refi, Nick, you're a little bit better at this than me. I want to say it's 5.15%.
We're at 5.15 on Riverview, Douglas Trail, Nicholas, we're at 4.5 for 7 years, plus 0% on 11 million on Nicholas. We have 5-year seller carries at 0% on Riverview, City Hall. We have 5-year debt on all these. City Hall was 5.3%.
What about specifically our Fund 1 single family homes? I'm trying to pull up.
You're putting me on the spot here. I don't know that exact figure off the top of my head. It's going to be somewhere between 5 and 6% though.
Okay, that's my recollection of it as well. I had 5.15 in my head.
Yep. That's probably a good guess. I don't know the exact number off the top of my head.
5.3. I just pulled it up from an email. So 5.3%. And we have that for up to an additional 3 million of lending. So that's already locked in, despite the fact that interest rates are changing. We made that commitment with our banking, with our lender in the summer. So that's how we work with that, is we have close relationships with many regional banks. We meet with them frequently. We make plans ahead when that makes sense. We sign contracts ahead when that makes sense. Nick and I sign full recourse on these notes to get the best interest rate and terms possible. So those are all of the things that we're doing to mitigate interest rate risk.
We actually, this might get a little bit abstract, but we actually locked a spread against the 5-year treasury for the single family homes in Fund 1. Normally you might lock on prime or something like that, but we knew that Fed rates were going up. So that's kind of like we're backward looking. The 5-year treasury tends to be forward looking. And we knew that at some point that 5-year treasury was going to go down. And we knew that the spreads were going to be shorter earlier this year. The spreads have blown up. They're much bigger today. So if we were to go get that exact loan today, we might be looking at like a 7% interest rate easily. I don't like to be particularly clever. I think that simplicity is the best way to execute. But in this case, we got pretty clever, and we were able to lock in really, really favorable debt back in June, and we're now reaping the benefits of that really favorable debt. I've not really heard of anyone else who's executed this kind of tactic before. This is a project we kind of made up with the bank because we have such a strong relationship with that bank. We've done millions of dollars of business with them, and it's really working out quite well.
Absolutely. Let's take a look at our financial performance. So this is again for Fund 1. So I'll try to kind of narrate it here for people that are listening and not watching. I know people are driving with kids, maybe still at work, on call, those sorts of things. So the dark blue line at the top is our total revenue, which is made up of Nicholas Real Estate and then the single family home portfolio. So what you can see here is in January and February, it was pretty stable. That's when we had acquired Nicholas. We were working on acquiring the single family homes. And then you can see a nice escalation all the way through the year. And we're at a little under 200,000 for the total portfolio for this quarter. And then our total income is the gray line at the bottom. And you can see from May onward, there's a nice upward slope. And that's as those single family homes, as they came out of renovation and started to be rented again. All of them are rented at this time. So we're seeing a steady increase of income there. And then our next slide here is our total expenses. So again, the dark blue line is our total operational expenses. The lighter blue line is for Nicholas and Oliver Apartments. The darker gray line is for Rochester Homes. And so you see here, our expenses are relatively low. That big bump in April is from property taxes. There will be another big bump in October. That's how property taxes are paid in our area. The thing that's really most important here to see is, we had expenses climb in our single family home portfolio as we went through the renovations. The overhead expenses, which is the light blue line, which you basically can't even see because it runs along the x-axis all the way until August, when there was a small $3,500 legal and accounting expense. There are no overhead expenses in our fund. So we have no acquisition fee, no asset management fee, no capital event fee, no construction management fee, pretty much all the fees. There are no fees. Just think of all the fee names. And so that's really important. It's totally different from the industry. We really hope that we are moving the industry in this direction, and that general partners can only profit the same way that limited partners can. And we hope that we put our model too of that limited partners get all of the capital back until they're completely repaid, and that general partners can also only profit after limited partners are completely repaid. And you can see that here with the essentially no overhead expenses for the fund. Here are some of the gorgeous homes that are owned by the Rochester Homes Fund One. That's the name of the entity inside of Black Swan Real Estate Fund.
Those are some gorgeous homes.
They are, yeah, and it's snowy and dark in Rochester, so it's nice just to see the blue skies and the green. We acquire a wide variety of single family homes in several different target neighborhoods in Rochester. We go all the way from 2-bed, 1-bath homes to 4-bed, 3-bath homes, really trying to serve a wide range of rental needs in Rochester. We really like 1960s ranches. We really like post 2000 split level homes. You can see it, a wide variety here. We look for things like what we have termed prepaid capital expenditures. So things like new roofs, new siding, new mechanicals like HVAC, anything that the market doesn't necessarily price into a home. The market tends to price in what a home looks like. So that's why we tend to acquire homes that need significant physical renovations, but it doesn't necessarily price in kind of the boring things that are the real value for real estate investors. So if we can acquire 2 equivalent homes, let's say they're neighbors, they have the exact same floor plan, exact same square footage, the interiors are exactly the same, but one has a new roof and the other doesn't, we're going to work hard to get the one that has the new roof. And that really helps with lowering our maintenance expenses over decades to come. And as part of that extreme ownership mentality, that we don't intend to hold these homes for just a year or two and do a renovation and then either sell them to an owner occupant or maybe put renters in them and then sell them to an investor. We intend to own these for 20 to 25 years. So we take great care of them, really steward them very well, maintain them very well. And I think you can see that from the pictures here.
We had a great question. Are you still acquiring single family homes? So we're opportunistic in doing that right now. Things are just on fire in the multifamily space. We're getting incredible discounts, very motivated sellers in the multifamily space right this second. So we're really, really excited to be acquiring we had not closed on a single multifamily deal this entire year until September. We had acquired a ton of single family homes, but no multifamily homes, because pricing was so high. We were writing offers, just nothing was sticking, and we refused to overpay. Right now, some of those sellers that turned their nose up at our offer 6 months ago, they're coming back to the negotiation table today, and we're excited to acquire those opportunities. And we're generally speaking placing this capital about as fast as it's coming in. The pacing feels really good right now. We don't feel the need to really slam the foot on the gas in terms of raising capital or in pushing additional acquisitions into our portfolio. I'm really excited with how fast we're acquiring right now. So right this second, we don't have any single family homes that are under contract. We did just close on a really cool single family deal, I don't know, a few weeks ago. I'm sure we'll get some more under contract here soon, just when opportunities come our way, or if multifamily slows down.
Absolutely. All excellent questions. These are the fees that we have waived for Fund One since its inception in Q4 of 2021. So we're at about 862,000 of fees that have been waived. That's obviously very important for the investors on the call, because that's profit that stays in the fund, that speeds up your return of capital, that increases your total rate of return, because the faster we can all get to that infinite rate of return period, the better that is for everyone. That is all of our slides for Fund One. So I'll kind of pause for any other questions that might come in for Fund One before we move on to Black Swan Fund Two. Or anything else that Nick, you might want to add?
This alone is one reason why we're able to acquire so many assets. If we were charging huge fees on all these acquisitions, that would actually, $1 million in fees that we've forgone in terms of compensation. That's, with the extraordinary leverage we're able to get, doing cash out refis, working with sellers, that's like an additional $10 million of assets we'll probably acquire in the fund, just in the fees that we've waived so far. So it's a double whammy, that not only is that money that the investors are essentially saving, it's pure savings for the investor, it's additional assets that we're acquiring that then get levered up 10x.
Absolutely. A couple of questions came in. How do we know when we are done acquiring for a fund? How do we know when we're kind of wrapping up the acquisition phase for that fund. So our target is to get capital back to investors as quickly as possible. We tell investors to plan for 5 years. Historically, it has taken more like 3 years. And we all want to get to that place as quickly as possible, because Nick and I don't get any compensation whatsoever until we've hit that milestone. And then that's what's best for our investors, because intuitively it should make sense that the faster you get your money back and you're in that infinite rate of return period and you have that money to do another investment or put a kid through college, whatever it is that you want to do, the better that is. So that's our main metric. And then we build the business plan around that based on what acquisitions are out there, how much capital we have, what our refis are looking like, how renovations are going. In general, I would say that for multifamily, our intent would be, once we do a refi, that is a return of capital back to our investors. With single family homes, it can happen so quickly that it wouldn't quite make sense to start returning capital so quickly and then reduce the overall size of the fund. So like, for example, some of the homes we acquired in Fund 1, let's say we acquired a home in February. We may have finished the renovation by May and have done the cash out refi. Well, it wouldn't make sense to return capital to investors like 5 months after they had just invested, and then in exchange, reduce the overall size of Fund 1. So we're confident that we can churn our single family home portfolio several times and still hit that, say, 3 or 4 year mark. But then, as Nick said, a few minutes ago, that growing the overall size of the fund is beneficial for everyone. So that's kind of a quick way of thinking of it, is that single family homes, we refi and then we keep spending the capital. Multifamily projects, the intent would be that when we do a refi, that capital goes back to investors. Excellent question.
Yep.
How much capital is left to be invested in Fund 1? So we're working through refining the rest of our single family home portfolio. When all of that is done, it will be about $6 million that we have back into Fund 1. So some of that has already happened. Some of the appraisals are in process right now. So it's kind of a moving target. But when all of that has happened, it will be about $6 million. About $3 million of that will go for the equity stake in residences at Discovery Square. And then about the other $3 million will be used for either a small multifamily project or to continue doing single family home acquisitions. All excellent questions. Mohammed asked, what is the tax implication for joining the fund? Nick, do you want to speak to that one so I can get a breath in here?
Absolutely. So we love to share depreciation with our investors. I mean, that's kind of a broad question of what are the tax implications. So let's be clear that Fund 1 is closed at this time. There's no more capital that can go into Fund 1, but Fund 2 is open, and Fund 2 is structured identically to Fund 1. So we expect to do cost segregation, accelerated depreciation, bonus depreciation, and share very significant amounts of depreciation back to our investors, especially in that first year when we get that huge bolus of depreciation. I don't want to quote you a specific number. There's a lot of variables in there. Maybe a Russia capital comes in at the end of investor capital that dilutes that year 1 depreciation a little bit. Now you'll get more in year 2. Maybe we get some really favorable acquisitions from a depreciation perspective. Or like this new deal is coming up in Fund 2, there's a little bit of bare land in that deal. So that doesn't generate a huge amount of depreciation. So I don't want to quote you an exact number, but there will be a very significant amount of paper loss in year 1. And the way we structure this fund with an indefinite hold period, you don't have to worry about recapturing that depreciation anytime soon. So I guess I'd call them sophisticated investors. Maybe the more sophisticated investors, that's kind of the first thing that they jump onto when they see our structure, is that this is a really, really favorable structure from a tax perspective, because we share this depreciation and then we don't recapture that depreciation anytime soon. I'd contrast that with, kind of a typical syndication or private equity fund that might have, like a 5-year hold period, but then if they might hit their business plan 18 months in, they're gonna sell that asset to kind of maximize the paper IRR, but that generates a huge tax liability for the LPs, for the investors in the fund. It's our intent to hold these buildings as long as it makes sense to do so, unless someone makes us an offer we can't refuse. So it's a very, very tax efficient investment opportunity.
Absolutely. Tomas asked about, is it smart to refinance in the current interest rate market? Should we have held the initial loan, or were they all cash purchases? So the single family homes, they were all purchased with cash. That's what allows us to move so quickly, get the best deals, close very quickly. It's not uncommon for us to identify a home that we would like to acquire and then close on that home 7 days later. That's what we've worked out with our attorneys, that we can do 7 days. They won't let us go any faster, do those renovations, and then do a cash out refi. So we don't acquire with financing. Then obviously there's no costs of lending that first round too. So all good questions. And then some other questions that we'll continue to answer as we go along. Yes, all investors receive a K-1. Yep. And then Tanya, I will answer that question as we go through Fund 2. It's about an infinite rate of return. So we'll just continue with Fund 2 and then answer those questions as we go. So let's talk about Black Swan Real Estate Fund 2. As Nick mentioned, it's legally structured exactly the same way as Fund 1. It's just a different set of capital and assets. So Fund 2 is a $30 million fund. We opened this fund in June, and we will be closing it for capital raising on December 23rd of 2022. And we currently have 5 assets that are owned in Fund 2, and we are under contract on number 6 and number 7. So we're very excited about that. That's why Nick's in Tacoma right now, is to do our due diligence on asset number 7 that's going into Fund 2. So just a really fast pace of acquisitions. Just like the lessons that you just heard in Fund 1, working as hard as we can to maximize the overall size of Fund 2 so that when we're in that infinite rate of return period, it's an infinite rate of return off of the largest number possible. Here's a summary. So we have Tanara Villa in Tacoma, Washington, a little over $24 million purchase price, 130 units. We closed September 8th. Nick, do you have any photos or videos of Tanara that you would like to share with us from while you were there today?
Yeah, I'm uploading some photos right now, as a matter of fact. So let me upload these and I'll be able to share those here in just a little bit.
Okay, sounds good. We have residences of Old City Hall, which is here in Rochester, $5 million purchase price, 22 units. That's the middle building there. So that was the Old City Hall of Rochester, built in the 1920s, a historic grand legacy asset right in the heart of downtown Rochester. Was converted to an apartment building in the early 2000s, and then we are acquiring it, doing renovations in the interior units and operating it as it is now, an apartment building. Hampton's Townhomes is a much smaller community, just a 12-unit townhome community, 1.6 million. We closed September 14th. And then we have Douglas Trail, 100-unit townhome community. Very excited about this one. This is our first foray into Section 42 affordable housing. So very excited about leaning into that mission, about finding a way to do affordable housing different. So for example, we are renovating all of the units, and that's a bit unheard of in affordable housing, but we really believe that there's a way to deliver a very high quality living experience that's great for those residents living in affordable housing and also delivers a great return while doing it in a way that doesn't create kind of second-class housing for people living in affordable housing. And then Riverview Apartments is $5 million acquisition. That's the bottom picture there, 39 units. So this is a 63-unit building in total. The other units are owned by owner occupants. Most of them are actually investor owned, but investors might own 1 or 2 kind of throughout the building. And so we acquired 39 units and control of the HOA. So it's a very profitable deal as it stands, but our plan is to continue to acquire all of the units until we own the entire building inside of Fund 2. If that never happens, that's okay. It still is a very lucrative deal, but if that does happen, that could like instantly double the value of the building that day, because then it would be a true apartment building instead of what it is right now, which is called a fractional condo. So very excited about the assets that are in Fund 2 right now.
I can share that media here on Tanara if you want.
Yeah. I will
Awesome.
stop my screen share and you can do yours.
So I've got some photos and such to share with you hot off the presses.
So someone asked, is Rochester our only market? So our 2 markets are Rochester, Minnesota and Tacoma, Washington. So I'm here in Rochester, Nick is there in Tacoma, and I am excited to see what fruit your trip is yielding here, Nick.
Yep. So this is one of the light rehab units. It's not 100% ready to go yet. We're going to share some stats on Tanara in just a moment. They're just mind-blowing stats. We're basically just kind of cleaning up some of the nicer units. So we've got a lot of units to go through, 130 of them. So the ones that are kind of in the worst shape, those kind of get added to the queue for deep rehab. And then the ones that are kind of in the nicest shape, those get added to the queue to lease. And then you meet in the middle. That's the kind of opportunistic flow that you have there. And if you've got, kind of too many deep rehabs, you're trying to throw more, contractor bandwidth at it. And if you've got too many units that are like pretty nice, you're pretty much able to lease them. You kind of need to throw more horsepower on the leasing side at it. So this is one of the nicer units here, and it's pretty nice. So this is one that's ready to go. So kind of a nicer finish on the cabinet, or I'm sorry, this one isn't 100% ready to go, but it's getting there. Both these. The fact is we're leasing these before we can even really renovate them, because our leasing performance is so strong. That's been our biggest thing. The previous ownership group just didn't really market these units. They had this restrictive covenant based on age that just makes, frankly, zero sense for the very young demographic that's in Tacoma today. So we have kind of overwhelming demand for these units. So here's the gut remodel unit. So we've got 4 of these that are in flight right now. So the existing boxes in the kitchens, really nice boxes. We're gonna see if we can keep them, and it's an experiment. So when you're doing rehab on a building like this, there's no master plan. People that pull up a pro forma and they're like, oh, we're going to spend, $736, on paint on this, that's not how it works. Like, you take a guess, our operational partner, Daniel Casey and Elaine and I, we've done, hundreds of remodels. So we know what we're doing. But we also know that you can't really predict what the outcomes are. So this is an experiment. We're going to reface these cabinets, refinish them, put new countertops on them, retrofit a dishwasher. Dishwasher is going to go into the left of the sink here. So this is the sink in the center. Dishwasher is going to go on the left. We're going to put a countertop here with like a little bar for stools here, range, microwave, and refrigerator here on the left. We're going to see if it looks good when we get done. And if it looks good, fantastic. And that's going to save a ton of money and lead time on cabinetry. If it doesn't look good, if it's not up to our standards, then we're just going to have to rip it all out and do all new cabinets. We're just going to have to try it and find out. The other big item in the deep value add units is retrofitting a washer dryer. So this is the mechanical closet. It's a huge mechanical closet, and just to the right of it is a coat closet. So what we're doing is, and it's a huge coat closet, so we're cannibalizing part of this coat closet here to do a stackable washer dryer unit, and then we have to retrofit 240-volt electrical, water supply line, water drain line, and HVAC ducting. So it is no small feat to retrofit in-unit washer dryers into units, but it's a huge value add item. I mean, if you think about it, we could go put really beautiful, fashionable LVP down throughout this whole unit, which we are doing, by the way. And 10 or 20 years from now, even though that LVP is still in great shape, it may not be fashionable anymore, and we might need to do new flooring. But we are always going to want to have those washer dryer hookups. I don't see a world where people stop wanting to wash their clothes, and they're always going to need that venting, electrical and water supply and drain to do it. It's really difficult to pull this off. So what we're actually doing is we're running a drain from this tub through this wall over to here, where we have to run like an 8-foot drain with all the proper angles and permits and everything. So it's pretty involved. So this first couple of units is just like an experiment. We're going to figure it out as we go, and then our expectation is we'll renovate about 4 units per month thereafter. So this is a deep value add unit. And then while I was there, we happened to own a Matterport camera and a commercial grade aerial survey drone. We're vertically integrated in all that we do. So I'm bringing like 50 pounds of AV equipment with me every time I come out here. But this is our ability. We were not able to capture this media when we were under contract because it's a little disruptive to have a drone zipping around. So we did not capture this before. So this is kind of an overhead, and you can see what these common areas look like. Like, this is extraordinarily valuable dirt. It's 1.6 miles away from Point Ruston.
I have to chuckle if any of you are not watching, and you're safe to do so, please don't if you're driving, but please take a look at the Matchbox car in the lawn to give you a sense of how large this lawn is.
It's insane.
This community would never be built like this today, ever. This would be a high-rise community. This dirt is so valuable. And so we're so lucky to acquire this because there's still 130 units. So it still makes sense for us to renovate this and to operate this with the buildings that are currently there, but then to create this common living space. You can see how all of the buildings face it and make this like the attraction, the reason why you would live in this community as compared to all of the other surrounding communities. And I just wanted to point out the size, and that's actually like a small SUV. It's not just a little sedan.
Yeah.
I just wanted to
Yeah.
point out the size of that to give you some sense of the scale of the lawn and why this is such a big part of why we acquired this asset and the value add that we're doing here to make this not just a nice apartment building to live in, but really a living experience, an indoor outdoor living experience.
So
I'm really amused. Sorry to interrupt you.
not at all. So in the lower left-hand corner of this photo, you can see a brand new school was just built. It was under construction when we got under contract on Tanara Villa. So that's always a nice amenity to have right next door. And then to put into context just how insane the location of this asset is. Elaine, do you remember the name of this bridge here?
The Tacoma Narrows?
Yeah, Tacoma Narrows Bridge. So this is like a world famous bridge. This is like a world landmark, just a gorgeous bridge. And this is the Puget Sound here. And you can see we're walking distance from the water and we're right in the peninsula. So you can see the water comes up here and here's the peninsula right here. So this is Point Ruston here. So this is 1.6 miles away. This is a multi-billion-dollar master plan community. This used to be an EPA Superfund site. The largest copper smelting plant in the world was here for 50 years. And then it eventually became a toxic waste dump. That cleanup effort, finally concluded recently after decades of work. And now there is a multi-billion-dollar master plan community there. So there is a bigger transition, a bigger change happening in Tacoma than any other market in the country that we're aware of or have physically, seen ourselves. And, it's difficult to overstate how ridiculously good the location of this asset is. We do huge remodels. So here's a Garden Court West, and we did amazing renovations. We're spending about $38,000 per unit.
Let me give a little context of Garden Court West. So Garden Court West preceded any of our private equity funds. This is owned in a joint venture, but it is the prototype for our acquisitions in Tacoma. So we did Garden Court West with a small group of investors, really build our operations there, build our team there. And then we acquired Tanara in Fund 2. And you can basically think of Garden Court West and Tanara as like brother sisters. So they were built at about the same time. Garden Court West is half the size of Tanara. They both need exhaustive renovations in all of the units, all of the common areas, the exterior, and then Garden Court West underwent a very exhaustive landscaping package, 1.3 million. At Garden Court West, we're going to spend about 1.5 million in phase 1 of our exterior renovation at Tanara Villa. So do note that Garden Court West is not in Fund 1 or Fund 2, but it was the prototype that we used to build our team in Tacoma, and it informs our business plan at Tanara Villa, which is in Fund 2.
Thank you for all that context. Yep. So it's not hard to look at Tanara. And I mean, you don't even have to squint to imagine these buildings that look almost identical to these buildings here. I mean, it's very similar construction style, very similar, year of construction, huge courtyard. When we acquired Garden Court West, the central courtyard was being used as an area to store appliances for spare parts. So there was literally just like dead appliances scattered around the courtyard. It was a community that needed a lot of TLC. And we've just, I couldn't be more proud of our outcomes on this project. And you can easily just imagine that same sort of just insane amount of landscaping investment that is just going to make this community look absolutely incredible. Garden Court West, we went from $900 per month in rental rate to $1,900 per month. In our next remodel, we're shooting for a $2,000 amount. And our data so far on Tanara says we're probably going to be able to reproduce that magic trick. Elaine, if you want to pull up the slides there, we've got a few figures we can share on Tanara. We're spending a lot of time on Tanara because it's a really, really big project. It's bigger than, many other projects in Fund 2 combined. So we've got lots of common area stuff underway. just, contractors everywhere. The biggest changes though have just been management. We've basically reached out to all the tenants, let them know that change is coming, showed them, what things are going to look like, finding out what they want, what they don't want. And then just started leasing units, and just by putting our management and light rehabs into place, the average in place lease rate was $925 a month on this asset. So after just a light rehab, we are at $1,525 per month on this asset. Just staggering performance. And we're working on lease renewals and escalations. So every one person that decides to vacate, we have 7 people that renew. So almost everyone is staying, and we couldn't be more proud of that. We've had about 70 units that we've reached out to so far. Most of these increases go into effect January 1st. We're working through our first 2 kind of fully renovated units. You saw photos of those. Those should be done by December 15th. And then we'll expect about 4 units per month of those heavy, very, very deep rehabs to come online thereafter. Then we're going to start working on some of our huge projects there in Q1. So on the bottom right corner, you see a picture of the clubhouse. So again, this was, a 55 plus community. And, it's really, I don't know, it makes me chuckle because it's really beautiful, but there is a library of VHS cassettes and a VHS cassette player hooked up to a, circa 1990 CRT television. Every amenity you could imagine that made a ton of sense about 30 years ago, this community has, and we're going to bring that amenity stack up to kind of the modern era. So we're going to put in glass walls, do a world-class fitness center with a Peloton gym and commercial equipment and weight stacks. We're going to have like a glass partition between the leasing office and the fitness center, have an outdoor recreation area. So you can, when someone's coming through for a leasing experience, they're going to see all those amenities during their leasing experience. Seeing what we've been able to achieve at Garden Court West, we're going to take it up several more notches at Tenara. I just couldn't be more proud of the work that we're doing here.
Yeah, absolutely. So we acquired Tenara at 24 million. We have pro formas. I think I wouldn't quite call it conservative, but our moderate after repair value is 36 million. There are some pro formas that go, higher than that. It's based on, what we can accomplish, but then also, as Nick showed, what Tacoma can accomplish overall for the overall improvement of that area. So I hope you're able to see, from this webinar, it's so much more than we can do when we're under contract, when we only have, a few photos and then some plans to share. And it's even so much more than we can do in an email or anything like that, where we can show you kind of up to the minute pictures and videos and drones that we're able to capture to see the transformation. And to, you might ask yourself, well, how can someone increase the value of a community by say 10 or 12 or even more millions of dollars? And I hope you're able to see that with exhaustive renovations of every single unit, every single common area, all of the exteriors, all of the landscaping, restriping the parking lots, like no stone left unturned. And that's how you create the value. And you do so in a community that can support it, in a community that has that redevelopment and that growth potential all around it. So it's all about location. It's all about business plan and operations. Let's go on to Douglas Trail. We have a lot to cover tonight. Someone asked, Nick and Elaine are married. Yes, we are married.
Give Elaine a little hug here.
Oh, thank you. We've been married for 12 years. So we actually started our real estate investing journey. We both owned homes before we got married. Nick wanted to rent the home that I lived in. We moved into his home. I was the reluctant person that said, I don't want to do that. Renting is scary. Real estate investing is dangerous. There's all sorts of risks associated with this. I just want to be a newlywed and have babies. And he convinced me. He said, let's rent it for 1 year and see what happens. And the rest is history. And here we are with 330 million in assets under management. So thank you for noticing that we have a little chemistry. So Douglas
I like our chemistry.
We own that one here in Rochester. We acquired this just a few weeks ago. We purchased this at the same price that the previous owners had acquired it for in 2017. So we essentially had like a 5-year runway. We acquired this at the 27 15 price, despite the fact that real estate values have climbed tremendously. And the reason for that is the seller had a variable rate loan and they were no longer able to service their debt. And so when folks ask, are you worried about interest rates or what do you think about refinancing? We think a great deal about it because we see what I would consider to be a horror story, that these owners owned this asset for 5 years and basically didn't profit from it because they had to sell it at the same price that they acquired it for because they had a risky debt instrument in place, or in my perception, a risky debt instrument in place. So all of our debt is fixed rate debt. We don't have any variable rate debt in our entire portfolio. In our entire portfolio of $1/3 billion, we don't have a single piece of variable rate debt. But we love acquiring properties from folks that have found themselves in trouble. We obviously love acquiring those deals for our investors and passing that wealth creation on to our investors. And we like solving problems for people and having the opportunity to come in and really steward these communities and take great care of them. So we're at 5.15 fixed interest rate on Douglas Trail. And we actually already have an offer from HUD for a full cash out refi on this community. We are going to complete many of our renovations because we want to drive the asset value as high as possible before doing a cash out refi. But it speaks to how even HUD has recognized that we've acquired this community with so much equity that we could theoretically do a cash out refi immediately. Our projected cash on cash rate of return for year one is 17.
I think you buried the lead there that the debt sizing from HUD was 13 million. So 2 million more than we paid for the asset. So I feel like we might be in good shape on this one.
Absolutely. Our projected cash on cash rate of return for year one is 17%. Cash on cash isn't as important to us because Tanara Villa is our business plan, which is to acquire a community, to operate it very well, to do large renovations, and then to do a cash out refi. But it is important to have safety and security during that period of renovations. So we really like for everything to cash flow during the renovations, and then that cash goes back to feed the renovations. And so we see that here with a 17% projected cash on cash for year one. You can see some of the units here. They're certainly not bad. This community was built in the early 2000s, has nice vinyl siding. We negotiated all new roofs during our contract period. I moved the slide there. We negotiated a large amount of driveway repair during our contract period. So about $1 million of capital improvements went into the asset from the seller's pocket while we were under contract. $1 million, so about 10% of purchase price went back into the asset in capital improvements with all new roofs and many new driveways before we even closed. There are the units down there. They're certainly not bad. They're actually quite nice. This is a nicer unit, one that's been very well cared for the last 20 years. You can imagine many of the units look like this, but have 20 years of wear and tear. So a unit like this, we might leave, but a unit like this that has 20 years of wear and tear, will do a full renovation. And that's what you see here. So literally the day we closed, we had our contractors there taking out the flooring. You can see here they took out all the carpet, took out the flooring there, and then we put in luxury vinyl plank in all of our units. We have the same luxury vinyl plank in basically all of our units across the entire portfolio. We've picked the best product at the best price that's great to install, that we can get readily in the supply chain, and we put it into all of our units. And we work very quickly. So we have 6 renovations in progress. We have 1 complete. And then of course, we're finishing up more this week. So we have 57 job sites across the entire portfolio currently in renovation.
Yeah, our initial performance on this one is off the charts. I felt a little nervous because when we got the appraisal done, the appraiser looked at our pro forma and said, there's no way you can achieve that. That's too aggressive. There's no way you could lease the units for that much. And after point out all the reasons why it wouldn't be possible, and I felt very confident in our numbers. Historically, I don't think we've ever failed to hit, and we typically exceed our pro formas. But there was definitely like pushback from the appraiser on this one because we were planning on making such an insane difference on this asset. And we've already secured 6 leases on this asset. So the in-place rental rate on a 2-bed was $875. Our 2-bed rental rate right now is $1,250. So we went from $875 to $1,250. On a 3-bed, the in-place rental rate was $1,050, and we're at $1,400. So we went from $1,050 to $1,400, and we don't even have a show unit yet. Like just just answering the phone and caring about people, serving them, and showing them what we're able to achieve at other assets. So basically our 6 active rehabs that are underway right now, they've all already been leased to people who haven't even seen that finished product yet. So clearly we're still low. Like our rental rates still need to go up quite a bit. We're in the slowest time of the year, and we're leasing these units at a ferocious pace. So clearly our pro forma was conservative, and we're gonna exceed that pro forma in a huge way. I've been shocked at the performance on this asset and how quickly that performance has been achieved.
Absolutely. Let's talk about the Riverview. So this was a $5 million acquisition. One of our banking partners brought us this deal because the operator at the time was struggling. They were trying to operate this building as a short-term rental, essentially running it as a hotel, and they were struggling with that. So we acquired the building again at the 2017 price. That's just a complete coincidence. But obviously we're able to buy a building at a much lower price than it's valued at today, and then serve our banking partners. So you can see how we are in relationship with our banking partners. So of course it's great for us. It's great for our investors that we're able to acquire this amazing asset at the 2017 price. And then it's great for our lenders that they remember that we are people that help them when they are in trouble. And it's a win-win deal for everyone. We helped the operator get out before they started getting into negative cash flow territory. So really just solving problems for everyone. And in doing so, creating a tremendous amount of wealth. We are moving very quickly on renovations in this building. So you can see there, the bottom picture, those are the current units. So I would consider this to be, a notch or two less nice than say the units at say Douglas Trail that we just looked at. The cabinets are much cheaper. The flooring is much cheaper, older appliances. So really we moved even more aggressively on our renovations for this project. We have 15 units being renovated right now. Part of the reason we were able to do that is because these were being operated as a short-term rental. So we just ended those Airbnb and everything leases. We didn't have to work around tenants living in the building, which really is kind of the way we would have it. Obviously, we work really hard on retaining tenants. We really understand that these are these people's homes. We don't try to come in and be very disruptive. You saw from Tanara, we have a 7-to-1 ratio of folks that renew versus folks that leave. But if we really had it our way, we would acquire buildings that were completely empty because we are such value add operators that it is more valuable to us to renovate a unit and to exercise our business plan than it is to have an occupied unit and to have to wait to do our value add plan. So this would just worked out really nicely. We also have fixed rate debt at the same bank at 5.5% for 5 years and a projected cash on cash of a little over 16% for year 1.
I have a fun photo I want to share. So Joey said those pink garbage cans always gives me a chuckle when I see photos of this asset.
Us too.
Share my screen here for a second, babe. So people frequently wonder, like, how the heck could you acquire a community and then go from $925 a month to $1,250, from $1,050 to $1,400 in a week? Like, why the heck didn't the previous management company, get those rents? Like, that seems unbelievable or whatever.
Those are kids.
So I don't know how this became our thing, but every Sunday after church, we go drive Douglas Trail. Right now we have someone driving Douglas Trail every day. So this community, it has individual trash cans for each unit, and there's 2 of them. And one of the trash cans is pink and the other is green with a red top. There's 100 units. They're all outside. And when the wind blows, they fall over if they're empty. So when you drive through this community, all you see is trash cans. Like they're the most visually obnoxious. It's hilarious. And then there's this spot in the community, and you can see it says no dumping. Violators will be prosecuted. And every time we drive by, there'd be new garbage that had been dumped here. You can see there's like couch cushions, a pallet, a kid's bike, a stroller, another kid's bike, a piece of furniture. And every day we would go pick up this trash, and we did this for like 3 days, and we're like, okay, let's put a dumpster out there. So you can see we dropped off a dumpster right here. I took this photo when we were driving through this past Sunday because I want to send a note to my team like, hey, we need to go pick up this trash and put it in the dumpster, and maybe like take down this sign and say like, please dump in the dumpster. Don't put the trash on the ground. And I hope it can make sense to everyone how a previous site manager, we actually retained the site manager through this project. It was a great site manager, just had some kind of handcuffs on them from policies from the asset management level. And I bet that asset manager was maybe really proud of themselves that they were like holding the property manager's feet to the fire by cranking down the garbage cost, by not putting out a dumpster for tenants to put out their trash. Well, when you do that, the tenants just dump their trash. If you don't give them a place to put it, it just ends up in the lawn. And habitual dumping is it's a common thing in assets everywhere. I hope everyone can understand that when you're driving through a neighborhood and all you see is trash cans and trash on the ground, that has a huge impact on your rental rate. All we did was clean up the trash and pay the little bit of money to put out a dumpster for people to put their trash in the future. All of a sudden we have this beautiful community. And how much do those tenants appreciate that? Do you think this might have been a point of friction for years? People coming into the property manager's office saying, hey, I've got an old bike to get rid of and it doesn't fit in this little bin that you've given me. What can I do with this? And the property manager says, sorry, I'm not allowed to get you a dumpster. And fine, I'll just throw it in the spot where everyone dumps their trash. How happy are those tenants? Like this is just the first little thing, and they know a lot of good changes are coming because this stupid little thing got fixed instantly. So just a little bit of insight into how we're able to add so much value to these assets so quickly. Just find the low-hanging fruit. Just make the simple changes that make the community that much better to live in, and are a negative on that leasing tour that hold you back from leasing the units. And you can have a 40% increase in your rental rate because the community is that much more desirable. When there's trash everywhere, the only people who are living there are the people who are living there because it's the cheapest place in town. And not only is that not a profitable business model, it's not a very fun business model. I like our business model where we make the assets as nice as we can make them, and try to meet people's needs and create as much value as possible.
All excellent questions and things that have come in. Hannah asked about 10% no interest, no payments. I think you're referring to the seller carry. So Nick was just talking about the trash cans at Douglas Trail. Hannah, I think you're referring to the seller carry at Riverview. So I believe, let me think for a second, but I believe with the exception of Tanara Villa, all of the assets in Fund 2 have a significant seller carry. So it's something we've been working with in a rising interest rate environment to work with our sellers to say, we'd like to hit the price that you would like. In order to do so, we need to find a way to lower our total average interest rate and our total average debt service that we have. And a way that we can do that is with a seller carry. So we've negotiated seller carries. You can see through on the slides there's a mention of a bullet point for each of those. So for the Riverview, it was 10% of the purchase price at no interest, no payments for 5 years. So obviously that allows us more time to work on our renovations, to do our operations, to increase the NOI of the asset. And then when we do a refi, we will pay the seller carry, return capital to investors, and then carry on in that infinite rate of return period. But it's great if you can own a portion of a building with no payments and no interest.
Yep. And that contributes to our bank leverage as well. So that allows us, we might be at like an 80% LTV with the lender. So in the case of Riverview, it's a $5 million purchase, 20% down, so $1 million down. But then that 500K seller carry, I think it's 550 or 600K, it's a little over 10%. The lender is basically counting that towards our down payment, and that's become our construction escrow. So if we're lucky in terms of construction costs and stuff, we will pay nothing out of pocket to renovate the entire building. So not only does that seller carry reduce your total leverage on the building, reduce your total interest costs. If you're able to negotiate with a lender that gets it and sees the value in that seller carry, it drastically improves the leverage that you're able to get on the building as well. And that's how we're able to acquire such a staggering amount of assets with a relatively small number of investor dollars.
Let's talk next about residences of Old City Hall. This is really exciting. So this building has a really special place in Rochester as the historic City Hall. Santa Claus also lands on the roof of this building, and then he is rescued by the fire truck. So that's happening this Saturday. Nick and I are really excited to carry on that tradition. Nick will be on the roof with Santa rescuing him. The kids and I will be on the street looking at this amazing rescue. But I just wanted to bring that up to speak to how we are part of these communities. We really believe in having, we have two markets, Tacoma and Rochester, and really being a part of those communities, having a large number of assets in those communities to have vertical integration and all of the financial things that go with that, but also to have the cultural piece, to be a part of what's happening for the day-to-day lives of the residents living in these buildings and the neighbors all around. So Residences of Old City Hall is part of our overall downtown Rochester campus. We have many buildings that are all within walking distance to the Mayo Clinic. We're really trying to create this living experience campus in our downtown area that basically any type of housing need that someone would have, from a small studio to, the units in City Hall are large, like two bed, one bath, like loft units. You can see they're like 2-story units with 20-foot windows, that any type of housing need, someone can come to the management company and have that housing need met. So we acquired this also with a seller carry, so half of the purchase price, no interest, no payments for 5 years. This was a little over $5 million purchase price. Very nice, grand building, and very nicely converted into an apartment building in the early 2000s. And then what we are doing is coming in and doing interior renovations. You can see here on the left side, those were the units as they existed, which is great for the early 2000s. And then on the right side is our renovations. We take out the carpet. We actually kept the cabinets. We just added pools there, and then added new stainless steel appliances. So I would consider this to be a very light renovation, like almost bordering just on like a turn. But just bringing these units up to match the view of the building when you're looking at it from the outside, when you're walking through the common areas, and then you would come into the units. Let's say you're on like a leasing tour, and there was just this letdown of like the story just didn't make sense. You're in this grand building with terrazzo floors and marble everywhere, and a 20-foot wide staircase and windows taller than you are, and then you would walk into kind of ho-hum carpet and rolled vinyl flooring and white appliances. And so we're bringing it up to modern standards. Very excited about the performance at Residences of Old City Hall. So our in-place rents went from $1,600 to $2,100, from $1,600 to $2,100. Our pro forma that we shared, like when we did our webinar launch for this one, was $1,800. So we're exceeding our pro forma by $300. And I hope you're seeing a consistent pattern there, that we tend to exceed our pro formas. We are hopelessly conservative with our pro formas. Kind of the way we write our pro formas is that we can sleep really well at night, knowing that if we just work hard, we're going to get it. And we don't have to like fight to get to our pro formas. We don't put out like our loftiest projections that kind of all of the stars have to align to hit those numbers. We really believe in putting out numbers that are aggressively conservative, is kind of how I might, the word
we lose a lot of deals because we're too conservative. We're probably conservative past the point of fault. Like, what if we missed City Hall because we thought we could only get 1,800 for it? Maybe we should be more aggressive. But at the end of the day, Elaine and I, we don't really need more, and we like to sleep well at night.
Absolutely. But it's good for investors, because you see that you come into deals with conservative projections and then we exceed them. And that's what we're excited to share about in these quarterly updates. We have 4 renovations in progress at Old City Hall. This renovation that I'm showing here is complete. This unit is already leased. We are working on washer dryer retrofits. Kind of, if you remember back to Nick talking about washer dryer retrofits at Tanara Villa, they're all that complicated. Adding washers and dryers to existing buildings is challenging, but we have found that it's worth the lift to get that. It's just a totally different living experience if someone has shared laundry versus having to actually take their laundry, to an offsite laundromat versus having their laundry right there in their unit. So it's typically worth it if we're able to make it happen with all of the permitting and things that need to happen. Nick, anything that you want to add for Old City Hall before we move on?
I'm really excited about this asset. We're doing, kind of 4 at a time, essentially, which is the perfect pace, I think, for this project. Maybe you're seeing patterns, where we're doing, 4, 6 units at a time. We don't want to do every unit, at the same time. So each of these assets has kind of a digestible amount of units where you have like an economy of scale, you know, to do like, you get the plumber in there to do 4 units at once, get the flooring person in there to do 4 units at once. Not so many that your carrying cost kind of eats you alive, and it lets us experiment. So, you know, just couldn't be more happy with the performance of this asset. This is my favorite asset in the whole portfolio. This is so cool that we own. Yeah, we can't own the city, but we can own the city hall. And that's
Investors
pretty
really
cool.
like to see this one at our in-person event this summer.
Yeah.
And we were only able to take our investor group to look at the outside because we were under contract. We did get permission to take some of our VIP investors who stayed for VIP day on Monday into one of the units. I think it was maybe 10 people that were able to see it, but really excited for our next in-person investor event in September of 2023 to take people into this building, to be able to walk it, to see, you know, what a magnificent building is in such a special place in Rochester. Let's talk next about Hampton's Townhome. So this is a smaller deal. This gives you kind of a sense of what like a bread and butter deal is for us, the deals that maybe other fund managers would pass on because they're too small. But for us, we just kind of think of them as money machines. So this is a 12-unit townhome community purchased at 1.5 million. 25% of the purchase price was carried by the seller with no interest, no payments for 3 years. The rest of our debt is 5% fixed for 5 years. So we'll do an exhaustive renovation of this entire community. It will go a little bit slower, but just based on the current leases that are in place, we obviously allow those folks to finish out their lease. But when we are able to renovate them, it will be very quick. We anticipate a full cash out refi in about a year from this asset. So this is what we're able to do. You know, our business model is to take the capital from the fund, to acquire buildings, to do exhaustive renovations, to do a cash out refi, and then to return that capital to investors. We tell investors to plan for a 5-year period, but that we work as hard as we can to make that around 3 years. And you can see how it doesn't take very many deals like this that can turn very, very quickly to increase the speed that we're able to return the capital. So there, you know, it's not like poof, one day all of the assets will undergo a cash out refi all at the same time, because they're all, you know, acquired at different times and undergoing different renovations. But these smaller deals that we're able to move through very quickly increase the speed at which we're able to turn the capital, which then increases which decreases the amount of time that capital is invested in the fund. And then Residences at Discovery Square is the asset that we are currently under contract on. So this will be owned 50% by Fund 1 and 50% by Fund 2. And the reason for that is there's a construction component to this acquisition. And so it spreads the amount of capital that's needed, because it's needed over time as we complete the townhome construction. So it spreads that capital, which allows us to, you know, again, our focus is always payback period. So it allows us to have the best plan for spending the capital and then getting the capital back to investors in both Fund 1 and Fund 2. So really neat that we're running Fund 1 and Fund 2 concurrently. This has always been our vision all the way back to the beginning of Fund 1, that we would acquire Nicholas and Oliver apartments, and then the remaining capital we would work to get a larger deal under contract and partner it with Fund 2. And we were able to make that happen with Residences of Discovery Square. We also call this RDS for short. So if you hear RDS, that's Residences at Discovery Square. 129 unit apartment building in downtown Rochester, also 8,000 square feet of commercial space that's currently vacant. So we will increase the NOI by filling that commercial space. And then we will build out at least 9, but potentially more, up to 14 townhome apartments. So these are 2-story loft townhome apartments that are on the ground level of this building, and that will increase the value of the building. So between management improvements, filling the commercial space, and then finishing the construction on the ground level, that's our clear value add plan for increasing the value of this asset. We're acquiring it at $27 million. We are doing a contract for deed deal. It's a super complex deal. Nick has been on the phone with the bank, 2 other brokers, and the seller to give you some sense of how complex it is. We're the buyer, and the seller, we're just communicating directly to make sure that we're meeting everyone's needs. So we'll acquire this with only $3 million down. So $27 million purchase price, acquired with only $3 million down. You know, going back to talking about Fund 1, we want to maximize the amount of assets that are held in each fund. And this is how we're able to do that, by structuring deals that are win-win deals, but that are quite challenging, that take, I mean, Nick, would you say you're spending 2 hours a day on the
Yep.
phone for this deal?
Yep.
I mean, maybe more. I know you were,
Yep.
on the phone and
This
writing
is
things up
intense.
many hours this weekend. But that's what it takes to do a
Yep.
deal like this. If we acquired this by putting new financing in place, we would be at a much higher interest rate. So our interest rate will be 2.37%. So, we might be at 6 or 7% if we acquired it with new debt. And then we would likely need to bring, maybe 10 million down to acquire this. So instead, we're able to acquire it with 3 million down. We're able to get a few years at, 2.37% is essentially free money. And then the seller carry will be 4 million of the purchase price, and there will be no interest or payments on that for 2 years. So lots of different kind of valuable pieces coming together to make this deal so lucrative. It's a big part of our overall Rochester multifamily campus. I don't think we have a slide that we're sharing in this presentation. Maybe we'll put it in a Facebook group or an email that goes out in the next couple of weeks. That's an aerial view of all of the pieces of the Rochester campus, so you can get a sense how, if someone is looking for any type of housing in that area, it's likely that our property management company is a solution for them. And that's such a win-win in terms of supporting our leasing team, and then all of the operational efficiencies that come from that in terms of cleaning, maintenance, lawn care, snow removal. It's very easy to manage. I wouldn't say it's very easy, but it's easier to manage a large apartment building than it is a very small apartment building. It's even easier to manage many apartment buildings that are all within walking distance to each other. And so that's the vision that we cast several years ago for downtown Rochester, and that we're seeing come to fruition here. And then here's your slide. I'll let you speak to this, Nick, since you're the one doing all of the work on our acquisition financing.
Yep. So as Elaine said, I'm spending hours a day on this deal right now. We think that doing the hard thing is usually the thing to do, and we are taking the hard path here because it's going to allow us to get just an exponentially higher rate of return. I think it's entirely possible we could close by year end on this deal, which is would not be possible if we got new debt in place. We have to wait for the appraisal, bank approvals, that sort of thing. And we will get a very exaggerated amount of depreciation on this asset, right? Because we're going to put such a small down payment down on the asset. We're going to spend probably about $2.5 million on building out as many as 14 additional townhomes. We had previously thought it might be 9. Right this second, I think we're hoping it's 14, maybe it's 12 or something like that. We did our due diligence walkthroughs and did not have any surprises as a result of those walkthroughs. So that's kind of unusual, and we're unbelievably excited about that. We found 2 items. When you're walking, hundreds of thousands of square feet of commercial real estate square footage, and you find 2 issues, that's pretty darn good. We're pretty excited about that. We can hit the next slide there. So we have probably
you're probably looking for this slide.
Yeah, we probably have about 20,000 square feet of space to work with. The entire main floor of the asset has not been built out at all, which is a somewhat common strategy. You kind of build these things out in phases. So you build out the upper stories, lease them out, get them stable, then you build out the main floor, so that we are able to acquire an urban core asset with 20,000 square feet of blank canvas is just a staggering value add opportunity. This is really a story of relationship. So we have a fantastic relationship with the architect who has been working on this building for the last 5 years. This building is massive. It's an entire city block. So they had to put
the
together,
picture there. You can see that line of cars going along the building there from
it's
corner
massive.
to corner.
So they had to put together a ton of parcels, get all kinds of approvals. And we of course reached out to the architect to say, hey, what do you know about these build outs? Sometimes sellers will and listing brokers will maybe exaggerate some of the opportunities to add value to a property. And we were able to get the real story there. We probably have a closer relationship with that architect than the seller or the listing broker does. This is the architect who's doing multiple projects for us right now and is very excited to work on another project with us. She's helped us get in touch with a neighboring with a neighbor that might lend us their parking lot, which would be extraordinarily valuable. Pointed out how we can add even more units to it. We've worked through all the approvals, so we're more or less ready to go. We just need to pull a building permit, which we're not going to do prior to closing, but we've been able to do a massive amount of due diligence on these build outs prior to closing, and these are going to be gorgeous units. We're penciling in $3,000 a month for rental rate. We really don't know what the rental rate is going to be, but they're going to be our most premium units, with glass banisters and modern industrial design and 30-foot ceilings and floor to ceiling glass. And I mean, there's one unit that, we should probably pencil in like a $6,000 rental rate on this unit, because it's going to be just an insanely nice unit when we get done with it. That's just a little bit of information about the build out that we're going to do here at RDS. It's a really neat opportunity that we're unbelievably excited about.
Yep, we are penciling in $3,000 per month for the townhome unit rentals. There is a comparable asset in town where the rental rate is $6,000, to give you a sense of how conservative we are with our projections. So we just have to hit half of what our comp is, and that will make our pro forma work very well. And anything we get above and beyond that obviously just increases the return and makes our business plan work even better.
Yep.
Let's spend just a few minutes. I really want to focus on, this being an update webinar, but of course we had to talk about our new deal that we're under acquisition on in Tacoma. We just got under contract on this, I think on Thursday, and then Nick flew out last night. So let's share a little bit about this. This deal will go into fund 2.
Awesome. So we're buying 3 properties in Tacoma, Washington. We're getting a fantastic deal on this asset. There's a ton of hustle that's gone into that deal. Basically, 100% of the financing is going to come from the seller. There's no bank involved in this transaction, which is extraordinarily helpful with how high how high interest rates are. And it saves us a crazy amount of cost and time. And we've been able to put together an unbelievably favorable deal, because the seller's just going to put a lien on one of those 3 properties. So we're going to buy 3 properties and put seller financing in place, but there's only going to be a lien on one of those properties, which is crazy, because that means we can kind of do whatever we want to do with those other parcels and generate cash or profit on those other parcels. And that's just going to be basically pure profit for us. So any bank that would underwrite this deal, they would say that whatever profit or cash comes from those additional parcels, that needs to pay down the loan. You're not allowed to take that cash home, but we've been able to negotiate an unbelievably favorable set of seller carry terms on this particular asset. There's lots of things we could do here. It's in an unbelievably good location. It has the highest density zoning available in Pierce County, which is the county where Tacoma is located. It's in a really desirable location. In this first photo here, you can see on the far right is
we are just looking at my slide. Do you want to share your
yeah,
screen?
I'm sorry, hit the next. I have the next slide pulled up on my computer for some silly reason. Yeah, you can go ahead and hit the next one there.
So the next slide I just have is fund operations.
Okay, you have a different version of it than I do.
Yeah, so I'll stop my share and you can share your screen. This asset is just steps away from Pacific Lutheran University, a really nice campus feel there. And you go from this nice, kind of comfortable looking, feeling safe area to kind of the worst house on the block, so to speak. And so we're very excited about continuing to bring that path of progress into this area.
We're not buying the worst house on the block so much as we're buying the worst block in the neighborhood. So this is one of the buildings we're acquiring right here. So it's a very nice historic building. This half was actually built in 1990 after a fire, and it was built to replicate the original design aesthetic. So we're getting like relatively new construction units that look like old construction, which is just unbelievably nice. You can see there's brand new Class A urban infill construction next door. This is called Garfield Station. This asset's located inside of the Pacific Lutheran University campus. So this was actually the first dormitory building built for the school. Today, there are no students living in it, which is crazy. There's just, the same property manager has been in place for 25 years. That individual was about 70 years old. And, basically whatever assumptions you want to make about the asset, just having those two pieces of data are probably going to be pretty accurate. They've really taken great care of the asset. There's brand new roofs on the building. Rental rates are low, and there's huge missed opportunities to renovate the building, to market to students, and to capture the best possible rental rates. Here's an overhead view. So hopefully you can see this on your screen. So here's kind of the main building right here. And then here is one parcel we're getting, and another parcel, and another parcel. Technically, it's just 3 parcels, but it looks like it's 4 parcels. We are only going to put a lien on this parcel here. These parcels here can be redeveloped trivially into about 43 multifamily units, which is super desirable. I don't know if we're going to actually redevelop them ourselves, because just new construction is expensive. If we could put 100 units on the site, maybe we would do that. So for example, if we could buy this house right here in between, then we would be able to get 100 units on there. Maybe then it would be interesting, but building 43 units, it's probably more lucrative for us to sell it than to develop that parcel. And ultimately what this allows us to do is we can sell these adjacent properties to recover our down payment on the seller carry. So at this point, we've gotten all of our money back out. Hopefully it takes us, a year or two, tops to sell it. There's a theoretical universe where we could sell them all, within the next 90 days. Then we can still run our business model, or our main business plan on that primary building, and do our BRRRR business model, remodeling the units and creating massive value. So this is a ridiculously good deal. Just a ridiculously good deal. We'll do a webinar on it in the future, but just want to tease that just so happened that the day of our performance update webinar, we got this. I mean, this is probably the best deal we've ever done. Like, it's wild how good this deal is.
And that is going into Fund 2. Looks like my screen share is working. In terms of fees, so of course, Fund 2 has no fees, just like Fund 1. So fees that we have waived so far are acquisition fee, loan recourse fee. We don't charge a construction management fee. There's all sorts of fees that, typical fund or syndication might charge. I estimate we have waived at least 1.2 million in fees for Fund 2 already. And it's a $30 million fund. So that, just think of that ratio there. It's a lot of profit that we leave in the fund because we think it's the right thing to do. We think that general partners shouldn't have opportunities to profit in ways that limited partners aren't able to, and then it speeds up the rate of return.
Is this in addition to the fees we've waived in Fund 1, or is this inclusive of?
This is separate. So Fund 1 is about 800,000 and Fund 2 is about 1.25 million. So about $2 million in fees this year.
That's staggering.
Yep. Tanya and a couple other folks had asked about the structure of Fund 2, and I was waiting for this slide. And then hopefully you've kind of picked up on some of the pieces as we've gone along. So capital is invested into the fund. We have no fees whatsoever. We've shared the real numbers of what that looks like. And then all of the profits, whether it's from cash flow or cash out refi, goes back to our partners until they're completely repaid before any splits whatsoever. And that's what gets to an infinite rate of return. So once there's $0 left in the fund, then everyone stays in the fund, and it's a 50-50 split for about 20 or 25 years. We set that time frame just based on our own lifespan. We want to hold the assets for as long as possible, because once everyone has all of their capital back, then you're in a place where you're getting quarterly distributions, but you have all of your capital back and you're free to invest in the next thing or do whatever it is you would like to with your capital. So that's what an infinite rate of return model is. I hope you're seeing here the business plans that we put into place. They're all very similar. When people ask, what kind of deals do you look for? Well, we look for deals where we have a very fast payback period. How we get there is a little bit different. Sometimes we're doing interior renovations, sometimes exterior renovations, sometimes both, sometimes it's just management improvements. But whatever it is, there's a constellation of value add opportunities that results in a brief payback period so that we can get to that infinite rate of return period as quickly as possible. We do long-term residential real estate, Class A and Class B assets. We're in Rochester, Minnesota and Tacoma, Washington. I think that probably answers most of the questions. Let me kind of take a look. Someone asked about expected returns. Rachel, can you share a link to our PDF for expected returns in the chat? I think that's probably the best way to comprehensively answer that. In brief, kind of that first phase is we work hard to get all of the capital back. After that, we're in that infinite rate of return period. To predict that period, we have to look at our historic deals that we've put together over the last 12 years. And all of these are averages and they're projections. But I might expect that for every 100,000 that was originally invested in the fund, again, an investor has all of that capital back. But for every 100,000 that was originally invested, the return might be around 10,000 per year that would be paid out in quarterly distributions. And then about every 5 years or so, there will be much larger returns that come from future cash out refis. And those could be anywhere from 20 to 50,000, just depending on how many cash out refis we do that year, the size of the asset that we cash out refi, how lucrative that cash out refi is. And then that process will repeat itself about 4 to 5 times in a 20 to 25 year time period. And then at the very end, all of the assets are sold, that cash is put in the bank account, and then it's liquidated with the partners. So that's how we get to an infinite rate of return. That's kind of the returns that you might expect after that. And it's really important to note, I have to say it again, because there's this, for some people, it just doesn't quite click that you have all of your money back. You have all of your money back. So it's not a 10% cash on cash rate of return. It's an infinite cash on cash rate of return. It's an infinite total annualized rate of return. And really the real value of this investment depends on what you do with your capital when you get it back, right? If you go spend it at Vegas, well, then you've lost your ability to continue to invest, to continue to spool your infinite rate of return. But if you've done what Nick and I have done with our real estate profits over the years, and you reinvest it back into real estate, particularly if you reinvest it back into another infinite rate of return model, you can quickly own a staggering amount of real estate that you have no capital in, that you're getting passive income from. And that's really passive income. That's really generational wealth. That's really what moves the needle on someone's lifetime in a really quick period of time. That's our business plan, and kind of a few minutes there, but Rachel will put in our PDF that explains it a little bit better. Yes, our distributions are quarterly payments that go out. I think I've covered kind of most of the questions there. Someone asked about, are you getting all of these deals off market? I believe so. Nick, I can't think of any deals that were
Most
on
of them.
Yeah.
RDS was theoretically on market, but only barely.
Yeah, we had it under contract like the first day it was on market.
Yep.
We moved very quickly.
Yeah, we had a really good relationship with the listing broker. We'd closed deals with them before. We reached out and said, hey, let's make this an easy decision for everyone. And it just, that was a good one. But yeah, everything else is off market. So it's all about relationship. A lot of the things come to us from lender relationships, broker relationships. These are the people that kind of control the deals. We will routinely call every broker, every lender we have ever done business with, maybe about once a month. We'll do an outbound call campaign. I make those calls right now and just say, hey, how are things going? Good to chat with you. Are there any deals on your radar that, might be interesting for me to take a look at? When we talk to lenders, we say, are there any assets on your watch list, things that you're nervous about that you'd be happy if that seller sold that asset and we bought it? We would love an introduction. Talking to a broker, we might say, is there any, deal on your radar that you think would be a good fit for us, where we could, make this a really easy decision for the seller and get a really quick and easy transaction. So that's how we get most of our deals, is just through pure relationship.
Yep, absolutely. Lots of people are continuing to invest in fund too. So if you know someone that might be interested in an infinite rate of return model and generational wealth and 25 years of returns, if you like the deals that you're seeing, please make a referral to us. You can send them to meetblackswan.com. They can book a time on our calendar. Feel free to forward them an email, forward them a replay of this video. The vast majority of our investor network has come to us via referral, and we really appreciate that. We love knowing, this person is this person's dad's cousin. It brings such joy to Nick and I to really have these relationships with our investors. Many current investors are adding to their existing investment in fund too. That's very easy. Rachel can take care of paperwork for you. It's very simple. You can take care of it in like as little as 20 minutes. Someone had asked about if they added to fund to what is like the distribution schedule like. So all of the capital goes into the bucket, and then when distributions go out, it all goes out at the same time. So there's no like first in, first out or anything like that. And the reason we structured it that way is that in the grand scheme of a 25-year fund, this original period of capital raising and then deploying the capital is quite short. And so it makes sense to just return all of the capital at the same time and get all of us to an infinite rate of return period as quickly as possible. And then someone asked, what if the fund does not fill to a full 30 million? So I anticipate that it will fill, just based on looking at our capital raise. Capital raising is harder right now. A lot of people have been really decimated by the stock market or skittish about real estate. Our hope is that you see how these assets are performing and are excited to invest in real estate and excited to see that you maybe have more control over your money in real estate than you do in the stock market, and are excited to see that these big value add plans provide a lot of security and no fees, and all of your capital getting back to you is a very safe, recession-proof investment. If for some reason Fund 2 did not fill to 30 million, that would have no consequence whatsoever. It's simply a ratio. It's just the investment amount divided by the total investment amount. So it would have no impact whatsoever on investors in any way.
Yeah, I'm really pleased with how quickly the fund is filled up, kind of lining up with our acquisitions. I feel like we haven't had to, scramble to close on any of our acquisitions. And the acquisitions have just kind of flowed in about as quickly as the invested capital has flowed in, which I think is pretty perfect. And it seems like we'll hit, pretty much our goal amount, like right at the close of the year, which, yeah, just absolutely perfect time. I couldn't be happier with the pace of capital here. Great question here from one individual. What's the average rate of return Black Swan has had, cash on cash from the initial investment? So we can spend a lot of time talking about this, but I want to just kind of throw something out there. So earlier in the webinar, I mentioned if you reduce your leverage, if you get like a 50% LTV loan instead of a 90% LTV loan, you raise your cash on cash rate of return because you generate more cash flow because you have less debt leverage, you have less debt service. I hope that makes sense to everyone. So if you lower your leverage, you increase your cash on cash rate of return. Let's say, for example, you were promising your investors a 10% cash on cash rate of return. That's very easy to do. All I need to do is go get a worse loan. Literally, I just need to go get a worse loan. I need to get lower leverage, and that will increase my cash on cash rate of return. And this is a common strategy that some fund managers, some syndicators will do. In fact, what they'll frequently do is they'll over raise capital on the front of the deal. Maybe they need 5 million for the deal. They'll raise 6 million and then pay out that $1 million over the first several years to simulate cash flow. So they're really just kind of giving you your money back to you. And intuitively, it should be a little confusing how it is that someone could acquire an asset, be doing a deep value add, turning over tenants. So there's more vacancy, like you're pouring money into this asset. How would that asset be generating cash flow? Like that just doesn't track in my mind. And then the moment we've stabilized that asset, it's a race to a cash out refi. So we want to get that money back as quickly as humanly possible. So again, our cash on cash rate of return will look amazing in like year 3, year 4. If we leave that original debt in place, we'll have like a 30% cash on cash rate of return because our debt service is so low. But what we would rather do is again, put more leverage on that asset, because increasing that leverage increases your total annualized rate of return, your average annual return, your IRR, depending on which kind of metrics you want to look at there. So just as a really quick example, we're about to finish our refi on New 52 apartments. We bought this in 2021 in August of 2021. And we're about to hit a full cash out refi, less than 18 months later, maybe like 16 or 15 months later. I don't know the exact 16 months later. We'll get a full return of capital. 100% of those proceeds are going to that investor. So, that investor is basically going to get all their money back in a year. Is their cash on cash rate of return 100%? I mean, I think you could easily make an argument that that's the case. Is their cash on cash rate of return 0? Well, it's not 0 because they have received cash flow throughout the investments. Elaine, do you remember what the cash on cash rate of return on New 52 is? For the initial...
it's a moving target as we return
right.
capital, right? Because as we return capital, the denominator goes down.
Yeah. So I hope I'm answering your question here. So people frequently ask us, like, what's your cash on cash rate of return? So we've quoted a cash on cash rate of return in our pro forma for most of the assets here, 16%, 17% cash on cash rate of return. And that's our pro forma target during that initial period. So I hope that, let me be clear, I want to make sure you don't feel like I'm like dodging your question. We have given in this webinar exact pro forma targets. On many of these assets, we will hit a 25, a 30% cash on cash rate of return. But we would rather, the moment we're at a 30% cash on cash rate of return, that's a bad thing, because that means we could put more leverage in place, and that's going to really drive up our average annualized rate of return over the life of the investment. And
our cash on cash rate of return in that asset that you're talking about today is 32%. And so that's why we're doing our cash out refi to return all of the capital. And then we'll be at an infinite rate of return in that building for the next 25 years.
Yep. So I hope that answers your question. If anyone else has questions, feel free to pipe it in chat. This is a super common question that we get, and maybe we're diving too deep into the weeds, but the mere fact that people ask, what's your cash on cash rate of return? That tells me that they might be missing the point. They don't see the insane value of this fund, because the real question they should be asking is, like when we talk on the phone with sophisticated investors, they say, wait a second, I stay in that deal forever. So 10 years from now, I'm still in the deal, 15 years, 20 years, when you sell the asset, 30 years from now, I still get 50% of the sales proceeds. Sign me up. Just that immediate understanding there's no fees, 100% of the profit goes to our partners until they get their money back in an indefinite hold period. Like mathematically, you will almost certainly have better outcomes with this opportunity than just about any other opportunity I've seen, which is not an accident. We've done the math, and we need to be just a little bit better than everyone else, or I think we're a lot better. I'm biased, obviously, but that's typically how the numbers shake out there.
All excellent questions. I think we've answered all of them. Let's talk a little bit about the tech fund. So it is 8:40 Central. We try not to go more than 2 hours. We already have probably like longer.
My next appointment is in 45 minutes.
Longer webinar times than most others. But let's talk about the tech fund. So the Black Swan Technology Tech Fund 1 is a $10 million fund in partnership with Lotus Domain. So Lotus is in their fund 3. Their fund is a $165 million fund that's available only to institutional investors. So we created an institution. We created the Black Swan Technology Fund 1 as a $10 million bucket in their larger $165 million bucket. Lotus has already been raising for about 2.5 years. So our fund is very advantaged that we are coming in at the end of the capital that can come into Lotus. That's a very privileged position because we already know the tech companies that are owned by the fund, and we're already in the period where the pref is paying out. So the tech fund is very different than our real estate fund. It is much more structured like kind of a typical private equity fund. These are our partners, Scott Ryan and Christian Mack at Lotus. So what is similar about the Lotus fund is that it's a value add operation. So Christian and Scott and Nick all have many exits in the technology world, probably, well over 50 years of technology experience between the three of them. So we do in the tech world what we do in the real estate world, and we do it for wealth protection and diversification. So all of our wealth was in real estate, and we were, looking at things with that. Well, we ought to have some of our wealth outside of real estate. We don't have any of our money in public equities, the stock market, bonds, anything like that, just cash and real estate and tech. And then we wanted to offer this to our investors as well, because investors came to us saying, I'm getting a little heavy on my real estate investments, or I'd like to, try something different. And so we offered this. The things that are very similar, that we acquire existing technology companies that already have proven revenue. So this isn't a technology company that has an idea. This is a technology company that has a product and contracts and customers and revenue. We shoot for at least 1 million in revenue per year, really more like 5 million in revenue per year, to really prove that that tech company is a real company that isn't just an idea that's going to go away when the next best idea comes along. 100% of all capital goes back to limited partners before there's any general partner profits. That's really important to us. So when we were creating our private equity model for our real estate funds, we went to Christian Mack. He's the gentleman in the center there sitting down, really just a titan in technology and private equity. And we shared with him our frustrations around private equity and how general partners have all these fees and splits, and there's so much obfuscation in the industry. And we were doing all these joint ventures, and we wanted to scale bigger, and our investors wanted us to scale bigger so that they could have more investment opportunities. We just didn't like the way private equity was run. And he really opened our eyes to say, well, just do it the way you want to. If you want to return all of the profits to limited partners first, you can just do that. If you don't want to have any fees, you can just do that. And so we really credit the existence of our real estate funds to Christian's vision for our real estate funds. And so in Lotus, 100% of all capital is returned to the limited partners before there's general partner profits. One thing that is different is there's a pref page. There's an 8% pref. Investors like that if they want to have some cash flow. And one of the things that's different about the technology fund is that the projected returns are higher. So in Lotus Fund 1, it was a 36% IRR. In Lotus Fund 2, it was a 42% IRR. Those numbers are challenging to reach in real estate. There's higher risk, higher return. So, we think of real estate as kind of the sweet spot for us for the vast majority of our wealth, where it's, really good returns. We can get to an infinite rate of return, but it's sticks and bricks and it's unlikely to go to zero. Technology companies can go to zero. We try to hedge against that by buying existing companies that already have revenue, that already have customers and contracts, but it can happen. So that's where kind of that exchange there is of higher risk, potentially higher returns, pays a pref. The fund is an 80-20 split. And it's a $100,000 minimum, which is the same as our real estate funds, except it's what is called callable capital. So only 60% is due by the end of this year. So that's 60,000 due by the end of this year, 20,000 in Q1 of 2023. We don't have that specific date yet, but you should be thinking about earmarking that in your your liquidity. And then 20,000 would be due in early 2024. And this is also a 506c, so you must be an accredited investor to invest. And then let's talk about our updates for the technology fund.
One just salient point I'll mention is that we have no fees whatsoever in our fund vehicle, which is really unusual. I've literally never heard of it before. So Elaine and I literally, we do not make a profit for each dollar that you invest, which is very unusual in the industry. Christian is just a huge mentor to us, and this is just kind of our way of giving back to him and giving back to our community to get some diversity, some exposure in tech. Certainly we will profit from this from the perspective that we can call Christian's personal cell phone and he picks up. That's pretty cool. Like I would love it if one day, Richard Branson or, name your, kind of celebrity of capitalism.
Elon, clearly.
Yep. Elon, yep. I want Elon to pick up the phone when I call his personal cell. So we benefit from that, just that we're doing something for Christian, and we want to play with someone who's playing at the next level, who's doing a $150 million fund, is doing a $500 million fund. So we're ready for that journey when it comes to us. But this is really just kind of a gift that we're doing, and we have $500,000 invested in the fund ourselves as well.
Lotus has already deployed 72 million of capital into 6 companies. The first distribution for Black Swan investors will go out in mid-December. So that will come from Lotus to Black Swan in mid-December. And then we will get that out to our investors as quickly as possible, ideally before the end of the tax year, just to make taxes a little bit easier. Investors must have funded in the tech fund by the end of November in order to participate in that distribution. And that needs to come to me in time to get it to Lotus. So looking at a calendar, I need to get it to Lotus by November 30th. So if you would like to invest in the tech fund to participate in the December distribution, you would need to have your investment wired to our bank account by November 28th. So Black Swan Tech Fund 1.com, you can sign the PPM, set up your transfer of capital. Because we're under such a tight timeline, I would recommend doing a wire transfer instead of an ACH, because ACH takes several days. If you have any questions, let us know. Either myself or Rachel are available to answer any questions. We've had lots of capital coming in to the tech fund in the last several weeks as we're preparing for this distribution. All right, Nick, do you want to speak to some of the companies?
Yeah, we're running low on time. Suffice to say, these are all solid purchases. So I have 15 years of experience, multiple, successful, like extraordinarily successful ventures in enterprise software, which is the very specific niche that the Lotus Fund invests in. I think it's the safest niche that Lotus the safest niche in all of technology, basically. So each of these companies are strong performers. At least $1 million in revenue. Many of them close 5 million revenue. They tend to supply, these are all B2B companies, so you've never heard of any of them, but there might be another company that rebrands their services. So for example, if you if you're using something on the internet, that thing is running on infrastructure and way down in the depths of the technology. There's a technology called Kubernetes, a container technology that kind of runs the whole show. And so that's a company that we've invested in. These are all just great. There's kind of a wall of text here of information about these companies, but you're welcome to kind of read that if you want. We can hit the next slide.
I believe that's the end of our stuff.
Yep.
I'll speak to Trellis. So Trellis is to Lotus as Black Swan Living is to Black Swan Real Estate. So Black Swan Living is our property management company that does all of the renovations that you're seeing, that does all of the leasing that we're speaking about, the maintenance, the operations. Trellis is essentially a technology management company that after we acquire these technology companies, Trellis it's at least a 51% ownership stake. So there's total control over the decision-making authority. So we typically move the owner of the company, the previous owner of the company, usually the founder, into like a chief technology role officer, or a chief technology officer role, and then place a CEO, place sales and marketing, accounting, all of the things that are needed to really mature and scale a business. That's what Trellis is doing day in and day out. So Brett is the CEO of Trellis and is the one that's working with these technology companies to mature them. And then the technology companies are sold. So unlike real estate, which has an indefinite hold period in order to have that infinite rate of return as long as possible, technology companies age a little quicker than real estate. So we do plan to sell these companies if we hold them for at least 5 years. There's significant tax advantages in that through the qualified small business program, no federal capital gains tax would be due. And we're already about 2.5 years into some of those holdings. So that's one of the benefits of coming into the Black Swan Fund is that we're at the end of Lotus. So we've already acquired the 6 companies here, and actually 2 of the companies we have like a second investment in. So the first investment has to be at least a 51% ownership stake so that we can have control of the operations of the company. And then for companies that are performing well, we acquire an additional stake if we think that that's financially a good decision to make. So 2 of these companies we have a second investment in as well. So really pleased with how the technology fund is going. I mean, I'm sure you can imagine at 165 million, it's a lot of moving parts. It's like the real estate fund, only much larger, and then a compressed timeline because we need to improve the companies, grow their operations, grow their sales through marketing, improve their financial performance with the accounting side, and then sell the company. And there's a wide pool of buyers that loves to buy technology companies at about 20 million in annual revenue. So that's really the target, is we're trying to get to 20 million in annual revenue, hold it for at least 5 years for the tax advantages, and then sell. So very excited about our partnership with Lotus Fund 3. And if you're interested in what you see here and you'd like to invest in the technology fund, you go to blackswantechfund1.com. We're getting a lot of referrals for the tech fund as well. I think people really like that, the pref, and want to participate in that. And then also that the capital is callable. So it's a way to kind of spread out the liquidity as you're investing. Maybe you're expecting an annual bonus or something like that. So any questions about?
Yeah, there are a couple of really good questions that came in there. I did not follow the payout process for the tech fund. Are these dividend distributions versus the infinite rate of return? Is December distribution the 8% preferred payout? So the Lotus model is more of a traditional private equity model. So there's not the infinite rate of return model there. And we're not saying that there will be an 8% payout, but you will be eligible for that preferred payment. And in any syndication or fund, if that preferred, if that pref cannot be paid out, in the current year, it accrues for the next year. So you have an opportunity to get in at the very, very, very end of this fund, where implicitly you're going to get the maximum possible return because you'll be eligible for the pref payment, and then obviously eligible for equity payments. You're in a much less risky or uncertain vehicle because we've already acquired these half dozen companies, just like how we've already acquired 7 properties in Fund 2. So you have a lot of certainty about what it is that your dollars are going into. So there's an inherent advantage to getting into a vehicle like this late, and we are the last dollars going into the Lotus Fund, our special purpose vehicle is. So to answer that question very directly, we can't promise that like it'll be an 8% payment. It depends on how much money is available. If it's less than 8%, we will pay out, whatever is available for payout. If it's more than 8%, which it won't be this quarter, but it will be at some point in the future, we'll pay out that 8%. Then you start getting a return of capital. So let's say you put in 100K and we were able to pay out 16K, and you're owed that 8% pref. That half of that would go to pay the pref. And then your initial capital contribution would be reduced from 100K to 92,000. So half of that payment would go to reduce your contribution. Your pref only accrues on money that you still have in the fund, so you'd accrue a little bit less pref in the future. But you are eligible for equity distributions for the whole life of the fund. So it's a little bit like that infinite rate of returns. It's unusual that you would get such an aggressive return of capital on top of a pref and you're never cashed out of the fund. So it's not the infinite return model, but it's a really, really, really favorable model for the investor. I hope that answered your question. And if you want, maybe Rachel throw a link to like Elaine's calendar or my calendar, Meet Black Swan, and we're happy to kind of dive into one-on-one conversations about this to make sure everyone gets that.
Someone asked, if we invest by the end of November, will we get 8,000 for the distribution in December? No. So you would get an 8% pref divided by the number of days that you are invested. So if it's 100,000, that would be 8,000 per year divided by 365 times the, let's say, 15 days that you're in the fund before the distribution goes out. So it's all proportional, but a lot of people like to get started on the pref train, and our expectation is that we will be able to do quarterly distributions going forward. Again, that's all an expectation. It depends on the acquisitions that happen, the capital that we're spending in the fund. But I just contrast that with the real estate funds. So some people like the tech fund, some people like the real estate funds. A lot of people invest in both because they complement each other quite well. So it's just a way to diversify your investments and to increase the amount of the different opportunities that are available.
Yep.
All right.
There was a question of what distribution might be coming this quarter. So we were originally thinking it was going to be like kind of a larger distribution, but we have a couple of opportunities very salient on our radar in the tech fund right now. So if we close on those opportunities, we're going to deploy that capital to go buy more companies versus issuing that pref payment. So it's tough to say. If those deals fall apart, which they very well might, there could be a very large distribution. You could hypothetically put in your capital, get your pref payment back, and get like a return of capital, in year one. Very unlikely that's going to happen, but it's a complete mathematical possibility with the way the financials look right now. And then if we happen to get everything that's on our radar right now, there would not be a ton of capital left to pay out that pref payment, but we're going to be happy about that because there's going to be an even bigger return in the future.
Someone asked about, after the return of capital, is there a split between Black Swan and the investors? No. So Black Swan has no additional fees, no additional split.
Super unusual.
It is as though you are investing directly in Lotus. The only reason the Black Swan fund exists is that Lotus is an institutional only fund. So individual investors cannot invest in Black Swan. So we had to do a $10 million institution, which is Black Swan Fund 1, in order to allow Nick and I to invest our own personal capital in the Lotus fund. So there's no additional fees, no additional splits. The only additional cost would be the tax preparations that goes into creating the K1s. That's it.
It's kind of like how we created our property management company so we could manage our own properties. Like, we would love to just give Christian $500,000, but we're not allowed to do that. Like, he would really like a $10 million check. So this is the best way for us to invest in Lotus, is to just bring along a bunch of our friends and in aggregate, invest 10 million or more.
All excellent questions. I saw that Rachel put our calendars there in the chat. I noticed that I don't have any times available between now and the end of the year. Rachel, will you put my email address? And I know I have some times in the next couple of days. If you have a pressing question, particularly if you would like to invest in the tech fund, just please email either myself or Rachel, because that one is a little more time sensitive. The real estate fund is also time sensitive, as we are closing it for investments on December 23rd. And the reason for that is we have 7 assets. We're going to deliver a tremendous amount of depreciation, and we want all of the investors to get that depreciation in this tax year. It would not make financial sense for an investor to invest in fund 2 in 2023 because then they wouldn't participate in all of the depreciation that's going out this year. So that's why there's some time urgency there. I anticipate that Fund 2 will fill. So if you know someone that would like to participate, if you'd like to increase your amount, please do so at your earliest convenience. If you have any questions, let us know. Otherwise,
or just anyone that would benefit from having a conversation with us. I spend most of my time talking to investors, just talking about their kids or their spouse or just whatever's going on in their life that moves the needle for them. If it makes sense for them to invest, great. It's honestly not very motivating for me to get on the phone and just talk to people about rates of return all day, every day, but it's really fun for me to just connect with people and just bring them value any way I can.
absolutely.
So if there's anyone that would benefit from a conversation with us, feel free to send them our way. If they've got a deal they're struggling with, or if they're thinking about getting into real estate investing, just any way we can provide value. We just try to show up for people. And sometimes Elaine and I know we did I think like a dozen calls or something like that a couple of days ago between the two of us. Like, it's a lot of calls, but we get a lot of fun out of it.
Absolutely. Yeah, I think Nick really explained that well and explained why, a lot of people ask, if you guys are financially independent, which we are from our own real estate portfolio many times over, why do we keep doing this? And it's really for the relationships. It's really to be in relationship with our investors, to show people what's possible, to deliver an infinite rate of return to as many people as possible for the next, quarter century, like to really think about generational wealth and the lives that we can change, to grow our team, to offer amazing employment opportunities, to see the people in our team that are so committed to our company grow in their own leadership and communication. It's all about relationships for us. That's what gets us up in the morning, gets us excited about doing these deals, is spreading this business plan to as many people as possible.
One thing we haven't mentioned yet is 5% of our profit from the fund goes to our staff as a profit share, and 5% of our profit from the fund goes to charity. That's something that really excites us. We just helped build a school a few months ago here. Our kiddos just moved into the new school. We found an unused 40,000 square foot office building, and got parents and teachers and stuff together over the summer to rip up carpet and paint walls, and our charitable giving funded a significant portion of that effort, as well as just kind of bringing our real estate skills to the table there. That's the coolest thing I feel like I've done all year. Like that's the thing that really gets us up in the morning is what can we do with that give back amount, and what's the coolest thing we could come up with.
Absolutely. Other things that we did, and by we I mean all of us, all of the investors, because we raised the capital into our family foundation from profits from our fund, and also from selling our single family at scale course. We put a commercial kitchen into the local homeless shelter. So very excited about that. They were operating with just a residential kitchen, which isn't appropriate for large scale food serving anyway, but then it was a kitchen that needed to be renovated. So very excited about that. We did a small donation to a homeless shelter in New York City. It was the child of an investor who came to our in-person event this summer, learned about us, learned about our charitable giving, and she has a relationship with this homeless shelter and asked, and we donated to that, really just to reward her ask. We have no real connections to New York City or to this particular homeless shelter, but really wanted to reward that and to see that generational change happen right before our eyes, that our investor is invested in, I'm not sure which project she's invested in, but she's invested in something. So wanted to come to Rochester, brought her daughter with her. Her daughter's seeing these things in action, seeing how business can be very profitable and create great good for the people that are in that business, but can also be a vehicle for change in the community and can drive charitable giving. And then came to us as, I think she's like 17 or 16 or 18 years old, like a young woman, and came to us and had like a very nice pitch saying, you have this belief in charitable giving. I have this relationship. Will you donate? And Nick says building the school was the coolest thing that he did this year. I think that was the coolest thing that I did, to see that generational change happen, to think that how much good is going to come from this young woman if she's making these kind of moves at 17 years old. And that we get to be just the tiniest part of that. And of course, I had to say yes to her, to reinforce for her that if you set your visions, they can happen, and that we could be just a small part in giving her some courage to ask in the future. So, yeah. Thank you so much for your time tonight. You all are such a sticky audience. You hang with us for hours and hours on end. I appreciate that so much. If you have any other questions, feel free to follow up on email or block a time on our calendar. Happy Thanksgiving to everyone. Thanksgiving is far and away Nick and I's favorite holiday. We are people that love to think about gratitude, love to talk about gratitude, and that there's a whole day, one day of the year that we get to just do that. Just take that time to really reflect on what you have to be grateful for, what you're grateful for in your past, what's going on well in your life right now, what you're grateful for in the future. It is nearly impossible to feel anger, sadness, or stress if you are in a state of gratitude. And so the more you practice that state of gratitude, you'll find that it's almost hard to get to a place of anger, sadness, or stress because your brain is so conditioned to be in a place of gratitude. And I just encourage all of you to spend just a few minutes on Thanksgiving Day, ideally as many minutes throughout the day as possible, to really say this is a day that's designated for gratitude. But even if it's just a few minutes when you first wake up or something before the hubbub of everything starts, to think about what you're grateful for in your past, what you're grateful for today, and what you're grateful for that's coming in your future.
I
Good
love
night,
it.
everyone. Thank you.
All right. Thanks, everyone.